for marketing, and they need it for and I think they're a better team. Moses, we got Moses. Okay. Welcome, Moses. Have the camera on, man. After what happened last week, please let's have the camera on. We want to see your pretty face. Even though if you're mute. Thank you. Thank you, Moses. Anything to share? Any stuff going on?
Well, I don't know.
Moses.
I saw a deal close in Sawgrass today. 89 million for 325 units. 2015
Wow.
2015 build.
Oh, okay. 2015.
100 585,000 square feet. 89 million. That comes out to $152 a foot. 2015.
How much per door?
275.
Whew, that's
What?
crazy. That's
That's
crazy.
cheap. Their 3 bedrooms are getting 38. Their 2 bedrooms are getting 32.
Yeah,
Their
yeah,
one
but it's
bedrooms
not
are getting
class A is not
29.
my thing. Class A is not my thing.
That's insanely cheap. That is insanely cheap.
Well, we are working on a 309 doors,
Mhm.
35 million. See the difference.
It ain't in Miami.
That's what I'm saying.
I'm talking Miami.
Back in the golf course. And the funny thing is that when we were going through it, I said
Where is
there's
that? 100 grand a door? That's where you need a shotgun, man.
well, that's the point, but that's what I was telling them. It's on the other side. No, no, it's not a gunshot, but it's in the wrong side of 635, the LBJ in Dallas, but it's in front of a golf course. Very nice during the day. It's beautiful. Now, what happened at night? That's the question, and that's what I was telling to the guys. Saying, listen, great price.
You know the secret, by the way. Well, I don't know if it's the secret, but when I was in St. Louis, obviously there's a lot of that kind of stuff. This guy, what he did was he had a problem with people stealing cars out of the parking lot.
Uh-huh.
And he thought the solution was, well, I'll just hire police. I'll have
Right,
police sit there all night.
right,
And it didn't do anything. All that happened was the people stealing cars just went to the other side of the complex because they knew where the cop was. And they
right,
stole it on that side.
right,
So what they ended up having to do, or what he ended up doing, is he hired undercover cops,
right,
unmarked cars, and he gave them a rent roll. And he basically said, if you see anybody that looks like loitering in any shape or form, you stop them. If their name's not on the rent roll, trespassing. And that cleared it up like that.
right.
No more cars being stolen.
Well,
So,
there is another story. Uh, this this is but again, I mean, this is in a C minus borderline D.
mm,
Um, these guys they were trafficking,
hmm
okay, and but they were paying on time. But there was just an assumption that the guys. Thank you, Miriam. Thank you, Evelyn. Um, there was an assumption that the guys were bringing bad people to the parking lot, and they were having some issues. Hello, hello.
hmm
And so what they did, they sent the property manager saying that, hey, during the all next week we're going to have a couple of dogs from the police because we are we need to check if we got any uh any drugs on the complex, etc. The guys for a week they were quiet, they don't have any issues.
hmm
So okay, it's confirmed these guys are the guys who are bringing all these things. So what they did, they gave free rent to a couple of police guys that they are K9, and that's it. The guys after 2 months they move. They say
Yeah.
no, we need to leave. Really? Well, what happened? You don't like the complex? No, we're moving. Blah blah
Yeah.
blah. I say, well, hey, thank you for paying on time, and now we know. But sometimes, again, sometimes those concessions is what you need to do to clean up some bad places. Um, but that's interesting. It's interesting. So 275,000 was the property in Soberas.
Per door. I mean, it's Class A, Triple A. I don't know if I call it Triple A, but 2015 build, Sawgrass. Very nice. Two pools, waterfalls in the pools. You know,
So it was
that
on the
kind of
market.
stuff.
Was a property on the market.
I didn't see it while it was on the market, but it closed yesterday. And then it was run by Amley or owned by Amley. And then Amley also sold one in Doral, a little bit more, 342,000 a door, I think it was. That was a 2013 build, but Doral's a little bit better market than Sawgrass. And it's like two of the biggest sales of the year so far. We're halfway through the year and the two biggest ones. It's very, very, very few transactions this year for multifamily. Very few. Like I think
Uh,
it's like 10% of what it was last year even. And last year was a down year too.
well, mergers and acquisitions is crazy. It's much, much higher mergers and acquisitions this year than last year.
Well, it costs of capital. That stifles transactions.
But I'm saying that there is more certainty. That's why there are more mergers and acquisitions this year than last year, because
Oh, you're
people are
saying you're talking
expecting.
about you're talking about on
I'm talking about transactions overall, just not real estate. So that
hmm,
means that a lot of people they're expecting that the things will go lower, even if it's
maybe.
one
I don't know. I think
one cut or more than one cut, and that's what
I
is going
think
to drive a lot of things.
I'm not expecting a cut personally.
Yep, one
I
one.
don't think they'll do it.
Anybody has any opinion? Miriam, Evelyn,
I don't think they're cutting
Moses,
rates.
any wants to vote if there is a cut
Well,
or not or zero?
Well, we're in a tough market, tough times, so I'm not sure.
Okay, that's the voice of a broker. She said that it's a tough market. Okay,
yeah.
Moses.
And it's all over right now. It's all over. And let's not forget also is election year, and we are in the second half of starting the second half of the year, which is going to be even slower. Okay, so not that I mean, sometimes I would say election, and in every country is the same thing. The year that there is an election, people like stand by. But I don't think elections in this country is going to have. It's more interest rates than anything right now in numbers. Okay, the numbers do not make sense. Everybody was expecting that sometime during second half of the year we were going to have lower interest rates. We are not. Maybe towards the end of the year, but yeah. So we have to wait.
Yeah,
Yeah.
I've been looking like most of like out of state. Like I've been looking at properties in like Georgia. There's this one in Warren Robins. Is I think it was two. It was two of them. One was like a 300 unit. The other one was like a 225 unit. But it was like a low. It was like a high vacancy rate. Like it was like 20% like filled. I think they needed renovation, but I couldn't really get the numbers right to see how much to estimate how much the renovation would even be.
Yeah. There's there's a lot of I've seen a lot of if it's below what is it, below 80% occupancy, it's considered a distressed property. I think that's where they draw the line. Starting to see a lot more of those pop up. Could be an
I could
opportunity.
pull it up. It was like I think they said like they had bad management. Like the previous manager was like handling it poorly. But I could pull it up right now actually and just tell you off the rate.
I think there is also going to come to the market properties that are resetting on the loans, and so that is going to bring us, I think, more inventory and more people that are going to be against the walls.
Well,
Oh, for sure.
we got two cases here. I mean, personally, I know one in Houston, 711 doors, big management company. They have like 15,000 apartments under management. And they bought this property lower 60s. Today they are selling it for 53. So they're losing 7 million more or less. And they're okay. They're
Yeah,
again
well,
15,000,
they're
they might make a lot of money. And they say, as long as you don't back off, we prefer to just give it to you 60 days, gone, and write off everything and move on.
Because with the
Uh,
write-off, maybe they're making money in some other thing. So
Oh, yeah.
that's balanced.
no,
Yeah,
they're probably in a position they can't get a new loan.
and that's also. But what
So
I'm
they only
saying
have.
is,
There's only one. If you can't get another loan, there's only one option.
yeah,
So
there is another guy, the guy that
they-
I was just saying, that is 300 doors. The note that he has right now is around 33 million. They bought it around low 40s, high 30s. So they're going to lose also 5, 6, 7,
how long ago?
2022.
Oh, they're
Well,
done.
Is
They're
yeah.
done.
it's an Indian group.
Bridge
Obviously, I have
loan, short-term loan.
it's a bridge loan, but I don't know if the guy forgot to do the insurance cap. I don't know
People are
why
blowing
the
through
guy.
those rate caps. People are just blowing through them. They're just
Well, that's what I'm saying. And this guy, that's what I'm saying, that property supposedly should be around, if it's in good shape, 120, 150 a door. Right
mhm.
now, we are offering 100,000 a door.
I'm
The guy
seeing.
doesn't want it because he doesn't want to lose any more money. And so we are saying, why don't you do a capital call? Like everybody's doing capital calls these days. You know? Well, I don't know
Yeah,
what is going to happen, but those are the things that Miriam was saying that I see happening, and they might happen more when we get closer to the end of the year.
yeah.
Because if there is only one cut, a lot of people, they are still hoping that some Hail Mary will
I
hit
think there
them.
might. It's. I think in theory, it's possible to have like one cut, but I think they're going to raise the rate shortly thereafter because I'm sensing that inflation is going to be running real hot for a long time, and it's going to run even hotter. So it's really hard to cut rates in that environment. And I think that's why I think that I don't think it's no rate cuts just from a political point of view, maybe, but it's more of they won't be able to stop the inflation, in my opinion. But anyways, we have a deal. We'll go through the deal. I'm waiting for your cue, JP, to go through it.
Just go. I mean, I have only one more comment. Carlos, do you want to share anything about your experience on the market these days? I know that you are
Hi everybody. I just logged on, so I don't know. I'm a little bit
okay. What
I
we were
didn't catch the
talking
whole
about,
conversation.
yeah, what we're talking about is that, for instance, I mentioned that I saw some people selling properties for a lower amount that they were purchased them 3 years ago, 2 years ago.
Yeah. I have a friend that closed the deal last week that he sold and he lost 30% for less 30% than what he
Yeah.
paid.
That's about
Yeah,
I'm
everything's
sorry.
down
No, he didn't sell
30%
it for
from
less
here.
30%. He lost 30% of the equity. So he sold it probably for less 10% than what he paid for. Or maybe he sold it for less 5%, but he had extra
Yeah.
capital for acquisition costs and all that stuff. And so he lost about 30% of total equity raised. And I think he raised 9 million, 10 million. So he lost about $3 million, two and change, $3 million.
How many years
Anyway,
did he hold it?
he bought it in 2021.
Yeah. Yeah, everything from the peak, which was basically springtime 2022.
Yeah,
all
20 to
down
40% down from that peak.
Yeah,
I
30,
have
30,
a deal
40.
that I had offers that I refused offers at $41 million, I think. 40, 41 is what I was getting, 40, maybe 42 if I remember correctly. And I'm about to go under contract for 32, so $10 million less.
What's the NO? What was the NOI?
I don't know that number off the top of my head.
Oh, all right.
But yeah, it was, when rates were cheap and everybody was buying, cap rates were low. Yeah, significant difference. So I think it's 35 or 40% less than what I could have sold it for a few years ago.
Yeah,
But that's life.
easily. Okay, well, JP, you want to get going? So we're
Yeah.
staying
Oh,
on time here. So we're gonna walk through a deal today. I'm gonna share my screen, see if I can figure this out. So share screen, and then I want to share this one. Oh, hold on. This one. You guys see something
it's coming.
on the
Something
screen?
is coming up. All right. Nice presentation. CBRE
Sunset,
Sunset.
Sunset Apartments. Now we're just going through this for uh analysis purposes. So don't share it with anybody, and don't tell Callum. All right.
This is a secret.
So this building we're gonna look at, it's a 1970s-ish build. It's in Miami. We'll look at the location in a minute, or South Miami, really. Sunset
Yep.
area.
I think I know it.
Yeah, it's been circulating around. So, oh, here's the map. So downtown Miami over here on the right, South Miami, Sunset, that's where the apartments are. We'll get into the numbers too, but roughly, I think it's 132 units, so medium sized. And it's 1970s build. One of the cute, did it go all the way to the bottom? What's my page counter not working?
It's on the other
Anyways,
side of Dayland Mall.
yeah, Santa Elen. One of the things that I like, so I guess when we walk through this deal, I'm just going to highlight things as I walk through a deal, things that catch my eye as good, things that catch my eye as bad. We'll look at the numbers as well, and I'll kind of just share my thoughts on that, and we'll get into the Excel about that. But one of the things I like the most about it, I guess, is 129 units. This was built 1970. It has had the same owner since 1970. And from
Wow.
my experience, when you have one owner for 50 plus years, they probably ran it fairly well because they've held it for 50 years. So they've had to maintain it. They've had to keep up with that. They've had to keep, their focus on it. And if they let it go deferred maintenance, it would have turned into a tragedy by now because you can't run it horribly for 50 years. So I have a feeling when we go tour this, it's going to be in pretty good shape. Yeah, it's going to be old, but it's not going to be in what you would call a deferred maintenance state, or it might be old. So I do like that component versus, buying it from a guy that bought it 3 years ago and it still has problems, right? They're just milking it. So we'll look at it. The mix, it is whatever. This one happens to have 81 units, 1 bedroom, 48 units, 2 bedroom. Their in-place rent is about $1,700 on average, which I think is pretty low for that area. And they have a market a little bit higher. And then they have in this model, they're promoting a capital expense renovation. So they think the rents can come up to about $2 or $2,000, which is about $295 a foot, which I think is fairly reasonable in that area. They're showcasing a little bit what it looks like inside. There's another rent analysis on the right. It's got dated kitchens, but they don't look horrible. It's not like terrible. It just needs to be renovated. It's probably never been renovated. Those might be original. Actually, they may have done a renovation at one point. They give a basic estimate on the upgrades: kitchen cabinets, appliances, countertops, mirror, shower. Basically, a once over on everything at $20,000 a unit. It's probably within reason. Of course, if we're real serious, we'll get a GC to double check that figure. But I think 20,000 a unit is kind of close. I think it would be a little bit higher, but it's definitely not crazy. And one of the things to think about, and I'm glad they did this little analysis here, this ROI, return on investment. If you're ever wondering when to do a CapEx, in my mind, there is a cap rate for every building, right? For every building in every area, a general cap rate. And right now, let's say it's 6%. So what that means is somebody would pay $100 to get 6%, $6 in return. So if the amount you're going to spend to earn the money is greater than a 6% return, it's a good decision, and I would recommend doing it. In this case, they're saying it's going to cost 2.6 million, and it's going to generate, because they increased the rents, 464,000. That's like an 18% cap rate. You can think of it as that for just this incremental change. So this looks like a good candidate for it because it's aged out of its useful life, right, for new renovation. This is some stuff about the surrounding area. We don't really care about that for right now. Blah, 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 blah. Here's a little bit of details on the building picture. You know, they got a pool. Looks in decent shape. Don't see like major problems. Got a little house with it. And 129 units. It's on 3.4 acres, 3.76 acres. So it's got a lot of acreage in Florida, South Florida. It's good to own a lot of acres because the land values are really what's driving the increases in cost for living down here. The more acreage you have, the better. So it's good to get a lot of acreage if you can. It's not in a flood zone, which is nice. They have the utilities here. Tenant pays electricity. Tenant does not pay gas. Tenant does not pay the water. Tenant does not pay trash. Tenant does pay for their cable. The water and trash are things that you can do what's called the rubs to charge that back to the tenant. So there's an opportunity to get more efficient on that, because what happens when you pay for you give somebody free water, they waste it, right? I get free water at my place and I'll let the shower run for 10 extra minutes and it doesn't bother me. So
Yeah, some people go to sleep and they let the faucet running.
Or toilets leaking and they don't care. You know, they'll let that toilet run. So a good way to kind of, you can't mitigate it 100%, but it helps to charge them back to at least feel a little bit of pain, so that it kind of reminds them not to waste the water. I just saw this electrical wiring aluminum. That might be a big problem. I'd have to ask. I think that's out of code now, so that might be a problem. Electrical wiring is aluminum. So, anyways, of course, you would go in and take a look at it. But we'll move on here. We will get into the numbers too.
One of the other issues that I see, I think, is flat roof.
It's 97% occupied.
Oh.
It says the roof was 7 years coated, whatever that means.
Yeah, but what I'm saying is that the roof, I think, was flat. So that's.
Yeah, it's a flat with, I forget the name of this style. There's a name for this style, but it's a flat roof. Of course, during the inspection period, you inspect. I'm assuming the roof is good, but if there's an inspection and the roof is bad, that's one of the items you go back to the seller and say, look, you know, we made this offer, so when the roof is good, it's not. We got to address that. One elevator per building. It's kind of interesting. It's only 3 floors. Still it's an elevator. Another picture, you know, Dayland Mall's over here. I guess it's kind of close to a Starbucks, not really. And more pictures, yada, 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 pictures. We already know all this stuff. Brokers love pictures. All right, the financials. So we can look at the financials here. I'm going to move it over to the Excel. So we'll jump into the financials in Excel.
Before we go to Excel, any questions to anything that we went through so far, or any comments, questions, whatever?
If it's 97% for people in it, how would you move them to renovate if you're going to renovate it?
In this case, you would do 1 unit at a time. You could maybe do some blocks, but it's not going to be a renovation where you kick everybody out, you go fix it up real quick, and then you get all new tenants. It would be in either unit by unit or in chunks over time, and you would schedule it out, and it would probably take 3 or 4 years to do it efficiently. So it's not a real fast type of value add, if that answers your questions. I would assume a renovation on this would probably take 3 years to get all the units done conservatively.
And how many doors?
129.
129?
And the asking?
We'll get to that.
Okay. I thought I missed it. Okay, sorry.
No, it's not in the deck. They do have it in the model. They have an asking, and what I wanted to was go through the numbers and then poll you guys on what you think price should be, and then let's see what they rate. But I have a feeling you'll be able to see the number at one point, so maybe we won't be able to do that, or maybe we will. All right, so let's move it over to Excel here. But that's a good question on the renovation, by the way, because you got to factor that in, how you're actually going to get the place to be better. It's not just a math problem. There's a schedule and everything that would go with it.
Right.
So I'm just going to use
other way to do the renovations, Moses, is that you raise more money, and so you cover massive amount of people that you want to get out, because what you're trying to expedite is the bump in the rents. But in the meantime, you need to, eat from somewhere. So you raise more money when you do the syndication, the raising of the money,
That's an option. And it all goes into the math of what's the expense of doing it versus the return. And sometimes it pays to go fast, for example. All right. So I know this is probably really small on your guys' screen. Let's see if we can zoom in here a little bit. Here's the overview of it. So the 1970. This is CBRE's basic model. So luckily they send it unlocked, so I can change assumptions in here. I don't have to move it all the way to my model and redo everything. I just use their model. Shows you up here what the mix is. The occupancy is 96%. I think it's 97 if you round it on the other side. What their current rents are, what they say the market rents are, what they say the post capex rents are. We already covered those. They give a 1-year stabilized kind of pro forma here. And this one is a bit skewed because they're assuming you do the renovation. So we're not even going to look at this. So I know it says an NOI of 1.96 down here. We're not going to look at that. They show some recent sales comps, not real useful. Looks like the average per unit is roughly 267. I guess the price is already on the screen. So they're asking 30 million, which is 232 a unit. And one thing to note, so you'll see this in-place cap rate over here. It says 5.4%. That is different than this NOI divided by the price. So that 1.9 is after they fix some stuff, 6.42. So the in-place cap rate, we'll look at that. That's what we want to evaluate on to some extent. And then they show some other metrics that we'll get through. Their growth assumptions, not super important because we're looking at what is it today. So they give us the rent roll. These are every unit. You can see which ones are occupied, which ones are vacant. We could say, okay, they got 6 units vacant, 5 units vacant, whatever. Looks like they have a manager's unit, they're giving a manager a 2-bedroom. Not probably the best decision, but whatever. And they have their mix up here. Again, just a more zoomed in rent roll. Another form of the rent roll. This is where they kind of just, stuck their thumb in the air and estimated what the value add would be. 20,000 a unit, probably. JP might know better than me, but probably within the ballpark. They're not doing windows. I would do windows. I don't know if you noticed, but the building has those old 70s styles windows where it's like multi-slat windows. I don't even know what you would call it, but I think you would want to do new windows. So I would think this budget would go up. All right, so here's the fun page. In place versus stabilized pro forma. Okay, whatever is over here, that's value add stuff. This is what we want to look at on the left. So we'll zoom in here a little bit. And I think their figures are probably pretty close. So they got their rent coming in. The total rent possible right now is 2.7 million. They got loss to lease at 4.6. They should have vacancy down here at 4. Now, really, that should probably be 5% at minimum. It's kind of aggressive to assume less than that. They have their employee units. So maybe if you add both of those up at 4 3/4, close. They have a little bit of laundry income, and then they have some other income, which are usually like fees, late fees, application fee, early move out fees, stuff like that. At 1%, that's probably reasonable. If you see something over 2, probably lofty. So that all
Well,
walks it down
they have
to,
opportunity here that they are not charging.
yeah, you can see right here, they call it out even. The water, this is the charge to the tenants for the water portion. And then there's other stuff too. You could
They have
charge
also the cable.
the cable, even the trash. There's
Right.
some new approaches charging trash. They also have that parking lot. I don't know what the parking situation is, but if that parking is desirable, maybe you could charge 20
The
bucks a
parking
month.
lot, actually, the parking, if I'm not mistaken, because I think I walked that place, the parking needs some help.
Maybe, yeah. And this is assuming that looking at the model now is assuming everything is fine unless they've disclosed it. Of course, when you go there, you'd see maybe other. But I will say, oftentimes when people are buying big properties like this, a lot of times they're like institutions. They probably will never even walk it before they get into the basically the contract negotiation. They might wait till after that to walk it for the first time. They're looking at all the financials, and then they say, okay, well, we have agreed here. All of our assumptions are it's good to go. Then they walk it and they say, oh, well, this is messed up. That's messed up. We got to address that. So it's an okay, I think it's an okay approach to do this without physically being there in advance of maybe submitting an offer. They got their OpEx here, so they got payroll at 110. Now, this is a difficult building for payroll. It's only 129 units. It only brings in $2.5 million. So it's kind of tough to pay people enough money to run this building full time. And it's not enough work to run it full time. So you're dealing with sort of part-time labor, which isn't always the greatest. If you can imagine yourself, if you're working multiple jobs, it's really hard to give all your effort and focus towards multiple jobs. You got to prioritize one over the other probably. And you deal with that here as well. So the labor is not going to be an efficient payroll property. And I think 110 is probably about right, but it is what it is. Repairs and maintenance, this is $500 per unit per year. Reasonable, but we're starting to see this number go up a little bit. You know, cost of construction is much higher, so maybe it could go up a little bit, but that's reasonable. Make ready turnover, this should definitely have something in there, $250 a unit per year, so they're missing that. Landscaping in the pool, okay, 23,000. Landscaping, elevator, fire, seems reasonable. Utilities, so this is almost 140,000. This is almost 1,000 a month per unit per year. So about $90 to $100, $80 to $100 a month. Maybe. I don't know why maybe the electricity is that high. Maybe. Okay. Administrative, they should definitely have
And
stuff in here.
electricity of the common areas.
Yeah, the comment 1,000 a month. Yeah, maybe. Administrative, the leasing, they got 0 and 0. You definitely have to spend for stuff. You gotta put this on apartments.com. So there's definitely some expenses missing here. Insurance at 137,000. That to me
90,000.
for yeah. Well, they're thinking they're gonna bump it up to 258. I'm not sure. I would get a quote from my insurance guy to say, what is it really gonna be? 137 sounds a little low to me. 258 sounds a little high to me. I think it's probably gonna be somewhere in the middle. But we'll get to that in a minute. Taxes. So one of the good things about, a lot of brokers won't include the new tax. CBRE in column, I think they did a good job here. This 392,000, that's not the tax they're paying today. That's the tax if you buy the property tax. So that was good on them to include that because that's an honest way to do it because that's what you're gonna have to spend on your tax bill at the end of the year for property tax. They also have their management fee at this would be property management, 3%, reasonable. You're not going to be getting a top tier management. This will be kind of a secondary or tertiary type of management firm, but 3%, you got to pay them. That's what they're going to charge. Maybe even a little higher, honestly, the small building, maybe it's 4%. but within reason. So all this walks down to, now they're missing a few things here and here, but it's 1.6. Okay, so you could say the building at best case scenario is going to make 1.6 million. If they want $30 million, they're selling this at a cap rate of 5.36. Well, the problem is nobody's buying at 5.36 cap rate. Nobody. So right off the bat, this price is a little too high. I think the prevailing cap rate right now is, for something of this vintage, is probably something closer to a 5.7, maybe a 5.8 in this area. And what the reason they're saying it's going to be a 5.36 is they're saying, well, you can come in, you could fix it up, you can make it better, and then you can get more income. Therefore, you can pay more in the beginning to take advantage of that. My big gripe with that would be, I would say, well, the owners have owned it for 50 years. If it was right for value add, why don't they just do it and then sell it for more, right? So it's not always a guarantee that when they tell you the value add's going to happen, it's going to happen. So I think if I would go to them, I would be lower in the 30, maybe 28, 27, something like that, to get this closer to a 5.7. That's not the whole story, of course. You have a scenario where, let's say we fix it up. That's what is showing over here. They're saying, okay, well, let's go through a scenario. You fix it up, you get the rents increased. So they wipe out this, or they increase. I'm going to hide this column a little bit so we can see what's going on. They're saying they're going to get another 464,000 from increased rent. This is post renovation. So where they were making 2.6, now they're saying we're going to make 3.2. They adjusted the vacancy to 5, which is fair. They kept the employee unit in there. Okay. And then they put in water reimbursement, which is that charge the tenants for the water. They just did at a flat rate. Maybe that covers it. I'd have to look at more of an analysis. They kept the laundry income. They kept well, their note doesn't match what they wrote.
It says in the 31,000, it says that they are going to put washer and dryers in units.
So,
but I don't know why they are
okay.
showing the same thing in place. Then
Yeah, that's a. Did they even have that in their value add? Yeah, washer and dryer, 4,500. Yeah. It's a small number at the end of the day.
yeah, but it's the same number that they have when it's stabilized.
Yeah, they
versus,
just ran it.
So I don't know what they're trying to.
That probably should come down, but I'd also say this number is low. This should probably be closer to 1 to 1.5. And I think you could charge for other things like the trash and the parking a little bit. But let's just assume it's right. Now we could, if we're gonna make an offer, we'd make our own assumptions in this stuff. Down here they got a little bit more for payroll. They got the R&M down to 300. That's ridiculous. I'm just gonna change this to 750. Right now, that's ridiculous. I think, well, maybe that seems too high. 100 grand a year. Turnover, this should be 250 roughly. 200 of those days are long gone. Landscaping, they put it. Now they had something where they were spending 1,000 a month on landscaping. This should probably be roughly similar. Okay, it is. Utilities. Now, you might ask, why are the utilities still up? That's because this is just receiving additional revenue from the tenant. It's not going to change, in theory, how much is spent, but I do think they would spend less, they would waste less water if they're getting billed for it. So this might actually come down a little bit, but then you have inflation, so maybe it goes up a little bit. So I think it's fine to hold it where it is. Administration and marketing, I think this is a little low. I would probably bump this up to at least 10 grand a year. Maybe we'll do 1,250. And then marketing and leasing, I think apartments.com is like 5 grand a year on its own. And then the leasing, so I'm going to bump that up to 100. Of course, if you're really serious about it, you go get estimates for all these things. You get the real number and then you plug the real number. We're just kind of flying here. Insurance, they think insurance could be 258,000. I'm just going to leave that
Ooh.
in. I think it would be less, but I think what happened here,
They double.
you know, we see a lot of OMs. I think CBRE and maybe some brokers in general, half the battle is convincing the seller that their property is worth a realistic price. You know, sellers think their thing's way up here. Buyers thinks it's way down here. The broker can either pull the buyer up or pull the seller down. And I think they did a lot of front end work to pull the seller down to something close to reasonable. By evidence being they put these taxes in, evidence being they put a high insurance number in. So they're kind of already working the seller for us a little bit here. So that, to me, that indicates there's, if we're talking about a negotiating tactics situation later, the sellers are soft, I think, in this scenario, because they're acquiescing to these good figures to put in the model. Management fee, they kept that at 3%. Again, I think that might go up a little bit, but sure, let's go with
Well, no,
3.
property taxes, they should go and put it 80% of 30 mil. That's what they should do.
Well, they have their model right here just for you, JP. So the assessed value, 24 million is 80% of 30. They put the millage rate in there. That's the tax, and then they do their early payment of 4% off. So they even show you the math. They don't just hand jam it in. They even show. So if we change this to 28, I think that number will even change with it. Yep, goes down. So that's a nice thing. Not all brokers do that. A lot of brokers just hand you a piece of paper, a PDF with some hand scribbled numbers on there. So this is very nice of them. So anyways, let's say you know, we clean this up. Let's even adjust this. Let's say let's knock that down 16,000. We'll keep that kept. So now we're pretty much probably where it is. So after the value add,
60% expenses?
No,
No,
I thought
40%. You just increase it by 2% from 37 to 39.
where are you?
Right there. 39, and before was 37. Right? Kind of tiny.
Oh, yeah, from here to here. Yes.
Okay.
And that's because
No much change. Not much change here.
and I think that's closer to realistic, by the way. 37 is pretty lean, very lean, especially with the new taxes in there. Even 40, I think, is still pretty lean.
Right. That's what
yeah.
I'm saying.
Yeah. But I want to knock this down a little bit to actually let's just take this out. If they're saying they're putting laundry in the unit, this is going to 0, right?
Yeah.
So all right, so now we're at 1.867. So let's do something here. They said the profitability was from renovation was actually going to create remember they said it was going to create 464,000.
Yeah.
I'll show you here. So they're saying you spend 2.58 million on renovation and you earn 464,000. Okay, maybe. But let's look at it from a more realistic point of view. This is what it is today. If you change nothing, that's what it operates out. And this is even being conservative because some expenses are missing. And then this is after the CapEx. Well, that difference is only 261,000. So what that means is after doing that renovation, you've only made 261,000.
After
more
$2 million.
profit. So if you have that 2.58, it's actually only a return of
10.5%.
yeah, something like that. 10.2. Still good. I would say do it. Still good. But it's not as good as the 18 that they were presenting earlier. And then this cap rate, this is the cap rate. So let's say you did do that. And this is your new NOI 1.867. And you still give them 32 million bucks plus this is a bad formula because it should be plus your CapEx, of course. Now you're at 5.7, which is probably where the market's at. But you're not going to do all this work just to be at where the market is at a 5.7. So to buy this, we got to be less. I think maybe something like, let's see what 28 million looks like. A 6.2. That means going in at a 5.8. Maybe that works. Maybe that's working. And that would be the conversation I have with them. Say, look, we could buy something that doesn't need any work for 5.7. Why are we going to buy this thing, spend 3 years of our life laboring over fixing it, only to be at the same price that we could be if we didn't do any of the work? And I think that would be a fair argument to get them down on price. Maybe even a bit more. Let's say 27.5, 6.3. Now we're starting to get somewhere. Now there's another component to all this we didn't even touch. And
Yield to
that is,
cost.
what's that?
We can do the yield to cost.
Yield to cost.
Yeah.
That's basically what this is, right? Or are you thinking something else?
Something like that. Correct.
So the other piece I haven't talked about yet is the debt. You know, it's a critical piece of this whole thing. The debt really motivates the interest rates, or I mean the cap rates. So in this example, they were nice enough to show us what the current debt options are. And the reason they do that is because CBRE, they sell buildings, but they also sell money, which is debt, right? So they'll show you, here are the options currently as of June 5th. So you can, for this 5-year loan, if you want full-term IO, these are some of the programs they think they can get you. A minimum coverage of 1.35 DSCR, loan to value of 65%. They calculate, I think that just hand jammed that in there. They show you what the spread is. And this is a spread over the 5-year US Treasury. So at the time they ran this, the 5-year US Treasury was 4.37. So 1.5% plus 4.37 equals 5.87. So that's how they calculated this is what the interest rate on the loan would be. Now, if this moves between now and you lock your rate in, let's say it goes up 1%, this 5.8 turns into 6.87. Or if it goes down, so it moves. They show you quickly what the math is for if it's interest only payments, if your interest and principal, what the DSCR is, minimum. I think that's just a formula. And then the debt yield. They want to see 8% plus on the debt yield at minimum. And this is a section called buy down. Some of the loan options, they give you an option. If you pay a little bit more as a fee in the beginning, you can buy down the interest rate. And in this case, they're saying if you spend 2% of the loan amount, you can buy down 0.38 of a percent. So you can convert this 5.87 down to, well, let's just do the math. I don't know what 0.38 is minus that, to a 5.49% rate. So they give you that option. And I don't know what this number is, increase in loan proceeds. I don't know what that is. This is a recourse. They say carve outs. That means it's a non-recourse loan. So if this thing goes belly up, they're not going to come after you for your personal assets. But there are carve outs. Carve outs are probably the traditional carve outs like fraud. So if you commit fraud, then they'll come after you. But if you don't commit fraud and if the market turns on you or whatever, they're not going to come after you. You might lose all your money in the deal, but you're not going to lose your house and your car and stuff like that. Here's some other just general terms. And then they also show a scenario for a bridge loan. So if you want to get a bridge loan, I don't think it's advantageous in this case. This building should qualify for a long-term loan day one, which is what they're labeling agency loan. But if you want to get a bridge loan, they show you what the terms are for that. They have some more backup information, rent comps, sell comps, stuff like that. It's kind of, to me, these sales comps are kind of out the window at this point. You can see these sales date, August 22, June 22, December 20. They're bringing a comp from December of 2021. Like, that's not a comp, guys. That's not a comp. The only one that is, this is June 2023. That's not a comp. That's over a year ago. So this is like, ignore it, basically. They show you the tax folio and stuff, all this other cool stuff, which we don't really need to look at here. So the way I would approach this thing, and I'm probably going to do this, I'm probably going to submit an offer on this. I'm going to call them up and say, look, guys, I think the market's at 5.7. If they think I'm wrong, I'm going to say, show me stuff that's selling for less than 5.7, and they won't be able to do it. So I'll say, I'll give you a 5.7 cap rate going in, which is 28, assuming you've told me everything about the building. And I think that would work. And there is a view where they show basically what that would look like from an investment point of view. You guys have probably heard of a term called IRR, which sort of calculates. It's a good analysis for the overall deal. So this view is basically that, brings in the profitability. Now this assumes you do a renovation in 1 second, which isn't going to happen. So I'd have to apply a time phasing to the renovation over the first 3 years. So let's say this is a very aggressive view, but the basics of it are there. It's going to make income. You're going to have your purchase price, your capex, your acquisition cost. You're going to have the loan. You're going to have the fees on the loan and the interest payments on the loan. I ended up going with in this model, a permanent loan, a 10-year with 10 years interest only, buying down the rate a little, buying down the rate to a 5.64% rate. And that's an 18.2 loan. And one thing that we can look at is the coverage ratio. Now, this is like I know I'm going through a bunch of stuff here, but this is not the correct way to do a debt coverage ratio. A true debt coverage ratio includes the theoretical principal repayment over 30 years as well. So if you get a loan that's interest only, the DSCR, they call it debt coverage ratio, but it's more commonly known as the DSCR. It's the interest plus the principal repayment, even if you're not paying back the principal. So this is more good as a metric than it actually is, but it is accurate in the sense that your income is going to be 1.85 times your debt payment. So that is technically true. It's just try to remember that if you're talking to people. And then that shows the cash flow. So at the first bit, it's going to cost $13.4 million investment. That's cash in the deal, down payment. Either you bring it yourself or you bring investors. Somehow you gather up this money and that's what you give the seller. And then the bank gives them 18 million. Year one, it makes about 860,000. Year two, 930, 999, whatever. And then this is assuming a year 5 sale in year 5. And they're saying they actually had this at 5.25. I changed it to a 5.5, which I think actually I'm going to change it to like 5.8. So in 5 years, let's say we wanted to sell this because we got to give the money back to the investors. We're going to sell it at $38 million. It calculates what the proceeds would be for that year using a 1% disposition fee. We'll make $40 million. That year. Is this is not a. See, they even have problems in their model. So don't always trust somebody's model because they didn't pay back the loan in this example. So this needs to be like this. You got to pay back the loan. You don't get that. They don't just give you free loan. So in this example, if all that happens, and this is aggressive because we know it's going to take time to do the renovation, this would only walk it down to a 14.4% IRR. Now that's for the overall deal. If you were bringing investors, they would get a little bit less of that because you're going to keep some of it for yourself. That's the GP-LP split. So this deal would be really tight to do with investors because investors are really expecting 15% IRR plus, especially on a longer term deal like this. The cash on cash is pretty good for the deal overall. Again, you would give less of this to the investor. So they might be like low fives, which is actually okay, believe it or not, in this market. But that's the deal. So I'll pause there. I know I went on quite a bit and a lot of stuff. For thoughts, questions, comments, anything like that.
Are you happy, Miriam, with the price of 30 million for the property?
No, we're gonna have to offer 27.
Yeah, maybe
No,
27.
30 is too much. Yeah. But 27, that's good.
It's 27. So that means we're going in at a 6-1 cap. Very, very reasonable. Still reasonable. And let's see what that does to the changes. That bumps it up to a 16% IRR. So in this case, if you're really tight with a GP-LP structure, maybe you can offer the LPs, your investors, something like a 14% IRR. Which is pretty good. It's pretty good.
Yeah. Yeah, that's good.
In this day and age, believe it or not.
Carlos, any comments? I know that you are undercover here, but do you have any comments on this?
No. Yeah, not really. I had a few comments going through and I kind of forgot what they were, so
Oh, come on.
yeah. Yeah, the insurance thought is I mean I how many units was this? 128, 130?
129.
129, so 130 basically. I mean, I've seen insurance at 2,000 and more a door. So it's not a surprise that they put that in there, and I don't think they would put that in there without having a good idea of what they're talking about, right? They wouldn't.
Yeah.
Their interest is putting as low a number as possible, not as big as as possible. So they wouldn't put a big number in there just out of the top of their head. So I would definitely not think that it's too high. The aluminum wiring is an issue to get Fannie Mae loans or Freddie Mac loan or any of those type of loans.
Yeah.
It's an issue. So that's kind of a big deal. I don't know what kind of breaker boxes it is, but a lot of that stuff in those years were Federal Pacific, which are a total cluster. So that's all I can think about quickly.
Yeah, those are very, very good comments. And in theory, with such a big needle mover insurance is, you really want to get a quick quote, even before the LOI, I think in this case, because it's such a big piece and you want to at least be in the ballpark on it. So that's one that I would recommend. And when we have our insurance guy, we always just ping him and he'll get us a rough estimate. But that's definitely one that you want to have your pulse on before starting your negotiations, basically. Which I view as the first conversation with the sellers. Basically, you're starting negotiating, or the seller's broker, I should say.
I got a
Okay,
question.
good points. Go ahead.
Most of the time when you're looking at these properties and you're trying to make up your offer and you're looking at the numbers and stuff, don't most of these properties ask for like proof of funds and like for you to like submit an offer with the proof of funds? But how do you come up to that number if you don't have all the financials?
Sometimes they do. I pretty much tell them I'm not going to do it, and just like, if we get to an agreement on a price, then yeah. But before that, we're just wasting each other's time. So, and
So you're just saying you're not going to give them an offer without
I'm
the
saying this
financials?
from the point of view you don't have it, right? I'm saying this from the point of view you don't have it. If you have it, sure, why not show it? But it's usually, I mean, some sellers get real picky over that, some don't. For example, I got under contract on the town center. I never showed proof of funds, and that's for mid 30 million range. So it's kind of, but I wouldn't back down just because they said. I would just kind of put it back on and say, no, I'm not going to do that until we have an agreement on price, and at least get the conversation going. Is there somebody
Do you
in there?
go and see the property?
Sorry, what's that?
Do you go and see the property, or this is all just you doing the due diligence?
I'm sorry, what was your question?
No,
I
well,
said, do you go and
if
see the
you, if,
property?
right. I
Do I
mean,
go and see
it
it?
all depends. It all depends. You can do it like he was, like Tim was saying, big money guys, institutionals might don't care. I mean, this is a small property for some of them. Personally, we usually go and look at it after we are in the ballpark of what they're looking for.
Yeah,
I,
it's much
I would
faster to just
absolutely go and see the property, and that gives you an opportunity to be building your relationship with that broker. Absolutely, I wouldn't be making an offer without having seen the property, because then you go and see it after, and it's like, oh well, I didn't know the roof was pink, and I'm not going to offer that much money. It's like, well, then you're just not even really a serious person, because you just made an offer and you're already trying to change it. So yeah, I would absolutely be looking at the property so that anything that I could see is validated, number one. But number two, that's the opportunity to talk to that broker and start the relationship building.
Yeah. I mean, what Carlos is saying is more traditional, and that would be the best way to do it. Um, um, more professional. But again, I mean,
The difference with institutional guys that you're talking about is when they ask the proof of funds, they send a proof of funds over with $500 million, right? So, okay, they might not be so worried that these guys didn't see the property, but they might ask them a bunch of questions about it. What they, how they figured their number out. But you need to, you don't have that proof of funds to show. You don't have that track record, so you need to build something else to balance out what you don't have, right? And the relationship is part of that.
correct.
And the other comment I had earlier that I said I didn't want to interrupt was about the rehab. I mean, 130 units, I would definitely be, shooting to do that in about a year and a half. 10 units a month, 5 to 10 units a month, depending on how move outs are. But 3 years in my mind is far too long to do any project. It just drags on too long. You want to be able to do the rehab, capture those high rents, and capture the market, and sell or refinance whatever the plan is as soon as possible, not drag it down the road. Because just imagine that this would have been a project that was 2 years ago, and you would have been able to refinance with a 3.5% loan, and if you miss that mark, you're now at a 6% loan. Imagine what a big difference that is in cash flow and in proceeds and all those and all of that. So time is your biggest enemy.
Yeah.
Moving slow is your biggest enemy. The faster you can move, and you want to move as fast as you can, always.
Yeah, this brings up a good point with the debt. Everybody in trouble right now is because of the debt.
Right.
Nobody that has a long-term loan, fixed rate.
No, that's actually not correct. They're in trouble because they pay too much. The debt is just a piece of that it's due now, and they can't refinance to what the debt they have because they pay too much. The real problem is they overpaid when they bought the property. Now, the ones that bought and got long-term debt, they'll be in trouble. And if they got a 10-year loan and they paid 40% more than what we said earlier, deals are worth 30 to 40, 20 to 40% less today than they were 2 years ago. So the part of that is cap rates, but a big part of that is insurance. So insurance isn't going to go down. So those even if the cap rates come down a little bit, or and interest rates come down a little bit, the insurance is not going to come down. So the value that the properties are worth less today than they were 2 years ago is partially because of the insurance. And that insurance is not going to be lower in 5 years. So in 5 years, when the time comes to sell or refinance, that piece of that value is gone forever. So if even if values come back to, if let's suppose it's 40% less today, and if it goes up and it's 30 or 40% in a few years, they're still selling at almost the same price that they purchased at, right? So the problem is not the adjustable rate. The problem is the overpaying for deals. You can't change what you paid for a deal. You can change the interest rate. You can get a new loan, or you can refinance and change the interest rate. That's one side of the deal. You can't change the location, and you can't change the basis, and that's the most important part of it. At least that's my opinion.
Yep, yep, and it's very valid. Thank you, Carlos. Yeah, yeah, it's true. It's true. I mean, again, I mean, some people they force the transaction. That's why, they couldn't afford the property, but they got into some kind of financing tools that they were too risky, and some people that they were experienced, so not just newbies either. So
So, yeah, for the folks that, bought with a low cap rate and their NOI just isn't that great, the insurance will definitely put them in a tough spot for sure. But it's hard to buy in a desirable area and not, I guess not overpay is subjective word, but real estate isn't foolproof. It's not without risk. There's any way you do it, there's risk, or and we spend a lot of time and effort to make sure you buy the best deal you can at the acquisition and not try and force a deal through just to get it done and increase your risk at some form or some position of the deal, whether it's a debt risk or a underwriting risk or any type of risk. Overpaying is a risk too. So I think that makes is a good point. And I hadn't seen those deals where they had long-term debt come across my desk. So Carlos, if you're seeing them, we'd be interested in taking a look.
oh yeah. I mean, right now you can buy assumable loans. I mean, that's one of the Panama City thing. I mean, we are getting into a potential loan of 3.15.
Yeah,
15
you're
years
not.
still in the loan.
Yeah, exactly. But 15.
Yep.
So how many years was the loan?
I don't know. Again, we are still going through
What kind of a loan was that? I've never heard of that.
negotiations, blah blah
Yeah.
blah.
But anyways, you're not seeing those deals because they don't need to sell them. They're not gonna.
That's what I'm saying. That's what I say. If they don't need to sell them, they're not in trouble. I'm talking
No,
about
no.
the folks
In
that are
this
Oh, they
case,
will be in trouble when they need to sell them because eventually the loan's gonna come up, and if they
but they got
if the values.
time heals all wounds, man. Time heals. Inflation ain't
Yeah.
stopped.
You can't
That's
compare the last 30 years where cap rates have, interest rates have come down and cap rates have come down, and it just hit a place where basically is impossible. They're not going to go back to where they were in my mind ever, and so
that
at a
might
higher
be
cap
true,
rate.
but inflation raises all.
Yeah, but
raises all boats.
inflation is bringing your rents up, but it's also bringing your expenses up. So your NOI might not have a huge, you might not get huge increase in NOI, and I mean that's my
I don't know.
opinion.
I would
So-
rather be in that position than have a short-term note. That's all I'm saying.
Oh yeah, no, I definitely agree with that.
Because the only other alternative is to not really play the game, because that's what the price was. In my defense, I didn't play the game. I was sitting on the
I have a lot of
during
friends that bought in
2022.
I have a lot of friends that bought in 2020 and 2021 and 2022.
It was a
And
tough
I have
time
one
to
friend
sit
that
on the
lost
sideline.
all of the equity.
Oh yeah,
I have another that lost 30%, and that's just two stories. I mean, I can give you
it's
15 to
sad.
20 stories, and so yeah, it is what it is.
Yeah,
but I didn't buy anything in those years, and not that because I was smarter, but I just didn't figure it out, and then I'm happy
I was
about it.
crying because I wanted to buy and nothing made sense. I couldn't. And
Yep.
it was frustrating because you're sitting there watching deals get done with horrible terms, and you're like, that's the market. So sometimes you just gotta wait. But I think we're in that brings up a good point.
Yeah,
If the market was horrible
now
in
is the time to
2021,
buy.
22, now is
Yeah,
I
I've seen
agree.
deals. I've seen some deals that are
Yeah.
starting to make sense. So yeah, absolutely.
Did you see the Amley deal close in Sawgrass today or yesterday? Did you hear about that? 89 million, 325 units, 2015.
Who bought it?
Um,
Is that the deal that Cardone bought?
now Cardone owns next door to it, but this huge fund, I can't remember the name of the fund, big real estate fund, value add fund.
Who
But it's
was
2015.
who was the selling broker?
I'm not sure. I just saw that on the real deal. It come through. I didn't see it.
Oh, okay. Yeah.
But 89 million, 500,000 plus square feet. Amazing. And then in Doral, they just sold at 350 a unit. I can't remember what
Yeah,
count.
that's actually across the street from where I go to dinner with a few real estate people once a month. Across from the Las Vegas Cuban restaurant. That was
Yeah.
also an MLI deal, wasn't it?
The Doral one, yeah, they closed like
Yeah.
Cancer
A week
I
ago.
think.
2 weeks
Yeah,
ago.
not
Yeah,
so
I saw that.
it's finally, I think people were holding on as long as they could, but the pressures are getting to them now, and this is a great time to be buying, I think, in general, just in general.
Yeah,
As
I
long as-
agree. I definitely agree. I am selling stuff to get some capital, so I'm gonna come back and start buying stuff now.
It was Messy Road that bought that 325 unit.
in Sawgrass?
Yeah, Messy Road,
Yeah.
or I don't know if I'm pronouncing it correctly.
That sounds right.
Is that a name you're saying?
Yeah,
What is that name again?
Messy Road. I don't know if I'm pronouncing it right.
How does it
Mess,
spell?
bro.
MESIROW.
Okay.
Yeah, they have like a huge fund. Like five
Okay. Yeah, that's
I
not
want
the
to say
deals.
five,
That's not
I
my
want to say
deals
5
anyways.
billion. I want to say they had
Yeah.
when I saw on the real deal, they had $5 billion fund or something like crazy
Yeah.
up there. And then they got a note for 71 million. So they paid 89. They got a loan at 71. What is that? 71, 89.
Like 75, 80%.
loan. It's 80%.
Yeah.
So we're back to 80% deals. Like all your
No.
Well, if
all
it
your,
underwrites,
No,
I mean,
you
it depends on
cannot
all
get
of
your
80% today.
no, it's funny
for
because we're
sure.
back to the books, the books that were written in like 2013, 2014, they're all 80% deal books.
It all
So-
depends on the underwriting. I don't know. I mean, they might have gotten that size of a loan, but it may include some rehab dollars, and those rehab
I
dollars
don't know.
might
It's a
be held
2015.
back.
It's 2015. It's hard to rehab. I mean, it's a premier. I don't know if it's AAA, but it's definitely Class A.
2015 is 20 years old. It's 10 years old now.
Yeah, but I mean, it's not Brickell. It's out there ways.
Yeah.
I don't think it would support a heavy rehab. Maybe some very light stuff. But anyways, all right. I got to run, guys, but it was fun to
All
join
right.
you
Nice talking to you guys.
today
Thank
and
you.
go through it.
We are done. All right.
Okay,
Thank you
All
very
right.
bye.
much.
Thanks. Nice
Thank
talking to
you.
everybody.
Miriam. Thank you, Evelyn. Thank you, Moses,
Bye.
Carlos. Thank you, Tim, by the way.